Hey everyone, Ben here. In this video, I'm going to be diving into a data center stock, which is a brand new SPAC, and it's still at $10 per share. So for those that don't know, that's the baseline for these type of stocks, which is a SPAC, which stands for Special Purpose Acquisition Company. You can basically think of this as the new IPO. It allows private companies to go public very fast, and really the idea of these is to get in them as close to $10 as possible. But for me personally, with this particular stock, I see it as a great long-term play. So let's dive into data centers and why I'm so bullish about them. So according to Gartner, worldwide data center infrastructure spending is expected to grow by 6% in 2021, as many corporate companies have been holding back their spending on data centers as they don't want to change all their IT around when there's a global health crisis going on. So basically Gartner is predicting this demand to rebound in 2021. So you may be thinking, what's so special about data centers? Why do we need them? Well, you may have heard the phrase cloud or cloud computing or cloud technology. Now the cloud isn't something up in the sky, guys. The cloud is actually these data centers which actually has this computing power and storage. This is where these companies outsource their IT to. What are the key drivers for the cloud and thus data center technology? So we've got a few key drivers of growth in this industry. The first is the Internet of Things, or IoT. Basically, this means the connectivity of everything together. So we have many smart devices these days, and they're all going to be even more connected together in the future. You might have an Amazon Alexa, you might have smart home devices, you might have smart vehicle devices, autonomous vehicle devices. All this is Internet of Things. All these devices require computing power, which is going to be off premises and thus in data centers. So other drivers of data centers include cloud data storage. You may have been onto your G Drive, your Google Cloud, that's cloud data storage. You may have a Dropbox, that's cloud data storage. All these are expected to grow in the future. So that's why I'm bullish on the data center industry, and I plan on investing into a few stocks in this industry. So in this video, I'm going to be diving into a SPAC which is still at very low price. So this SPAC was just announced today, and I did invest into the SPAC, and I alerted everybody in the VIP group. So if you guys want to join the VIP group as well and also get access to those early live updates and alerts, then feel free to check out that first link in the description below. Or if you're new around here, feel free to subscribe to this channel and turn that notification bell on. And if you do find any value in this video at all, feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. And with that being said, let's get into this company because I've delayed it for quite a while because I wanted to give you guys an overview of the industry. So the company is called Cyxtera, and it plans to merge with a special purpose acquisition company valued at $3.4 billion. So this is a data center co-location company called Cyxtera Technologies, and it's announced a merger with Starboard Value Acquisition Corp, SVAC, and this is going to be on the NASDAQ stock exchange. Well, it is on the NASDAQ at the moment. So here's the share price for Starboard Value Acquisition Corp, and it's looking quite good value at the moment. So it's at $10.35, guys. To put things into perspective, these SPACs start off at $10. So that's the amount of cash basically in the SPAC unit at the moment. So this SPAC's at $10 now, and this is where I've entered my position, and I did alert the VIP group also. Of course, it still comes with risks. For example, the SPAC merger might not go through. That is a risk with SPACs. Also, SPACs can be quite speculative because usually the companies that are going for a SPAC are more of an early stage company rather than a late stage growth company. But let's dive into this company, Cyxtera here. So this is the global data center platform. So this company offers a co-location service where basically companies can rent out sections of their massive data centers. But the special thing with this company is they also have a software side which has great cybersecurity applications, and that's one thing which I've not seen off any other data center provider. So this company currently has 61 data centers across 29 markets, over 600 networks, and over 2,300 customers. So this is still a big player at the moment. It's not the biggest in the market. I'll dive into some of their competitors soon, but as you can see here, here's some examples of their data centers here all over the world here, all over the US there, Europe, and in the Asia Pacific. So here's an article on the world's largest data center co-location providers. And as you can see here, the number one provider is Equinix. So this is the major sort of player in this industry. They have an 11% market share, and they're based in California. So this company here, this is the major player, but their actual stock, their publicly traded stock, is basically a REIT, which is a real estate investment trust. So if you're investing into that company, Basically, you're actually investing into the real estate. So all these data centers that this company owns. So they don't really have a software side of the business like Cyxtera has. But this is actually on number 13 on this list. So it's a small player, 1.2% market share, with a headquarters in Florida. So I believe Florida is quite good with tax, actually. So diving into the investor presentation for this company, the post-deal equity value, so this is at $10 per share, is $1.8 billion there. And as you can see here, the valuation looking at the 2020 EBITDA margin. So this company is profitable in terms of EBITDA, which is basically earnings before interest, tax, depreciation, and amortization. So this is a 15.6 multiple at the moment. And if I dive into some of their competitors here, Equinix, ticker symbol EQIX, which is a REIT basically, their price of sales is 9.92 and their PE ratio is 80. So this company seems to have a better valuation than the market leader in this industry. Also, look at the size of the market leader. It's a $59 billion market cap, whereas Cyxtera has a price of sales of just 2.6. I've also looked at a few other players in the industry. You've probably heard of Cloudflare. They don't really do the same thing as this company, but I've still put them on there because they're in the same sort of data cloud industry. They have a price sales of 56. Fastly, which is seriously sort of took a major decline as they had an issue with their major customer TikTok, they have a price sales of 28. So just to give you guys a little bit of a flavor of the valuations in this industry, and this company has a price sales of 2.6. So it is a smaller player. The valuation's looking quite good right now, and they do have some tailwinds behind this industry. So I think this could be a very interesting play. Cyxtera is the largest privately held global retail co-location data center. Well, it was the largest privately held, but now it's public, so it's a public held. But it's the third largest publicly held provider. So key stats here, we've got a 90% EBITDA margin on the business, which looks great. So this company has a lot of fixed assets. So once they've bought these facilities and actually purchased these large data centers and bought all the equipment in order to store them, then that extra capacity they have is all profit for the company. Apart from the maintenance and technical side for the business, they have quite high margins. So selected partners, they're partnered with NVIDIA, they're partnered with HP. But this is the special thing with this company. So comparing it to its competitors here, we've got Equinix, which I stated is a much higher valuation. And most of these seem to be REITs. So Digital Realty, this is a REIT also, I believe. So Equinix is a REIT. And as you can see here, Global Reach, they both have that. They both have this. FedRAMP certified. So this is something which the global leader, Equinix, does not have, and this company has. And basically, that's a security certification which says FedRAMP basically stands for Federal Risk and Authorization Management Program. And it standardizes security assessment and authorization for cloud products and services used by federal agencies. So basically, the goal is to make sure federal data is consistently protected at a high level in the cloud. So you could say this is a company which has one of the most secure data centers at the moment because they have their software side of the business, which does create this software perimeter around the actual business. More than 90% of the revenue is reoccurring. So if a company decides to set up with these guys, move into their data center, have their systems set up there, their IT systems, most likely they stay with the company. And that's why we see 90% of their revenue as recurring. And they have these long-term customer relationships with over 13.4 years for the top 20 customers. And this is what I mentioned previously, 70% of their cost structure is fixed. So that's the buildings, that's the equipment for these data centers. Previous booking growth, they call it, is 39%, which is great to see. Generally, I look for 20% on general growth. Long-term core revenue growth there, they're estimating 7%, so that's really quite conservative. So they're being very conservative with their growth estimates, which I do like. They're estimated 12% increase in EBITDA growth over the next few years. The run rate margin predicted for the future is 48%, which is also great. So a couple of negatives with this company. So I think the name's not that good. It's spelt like this and it's pronounced Cyxtera. Honestly, it might sound something immature and a bit sort of, oh, people don't care about that. I think people do, because if it's not memorable, then people have to keep researching up and they can actually forget about the company. And it might sound crazy, but I think little things like that do matter. Look at Tesla, why Tesla's so popular. Tesla's named after Nikola Tesla. But yeah, that's just a little side thing. More of a real risk is probably the net income being negative. So this company is unprofitable from that point of view. It is EBITDA profitable. So the cash flow was negative, and then it was expected to be positive for 23 million dollars, I believe. Now, I did notice this company seems to have quite a high amount of debt. So 1.2 billion financial net debt, including capital leases. So these could be major leases with these big buildings where they house their data centers. So some of their assets they actually own, but I'm assuming some of them they actually rent. And these are the big leases. So these are the financial net debt of the company, 1.2. But for me, I consider this a long-term play on the data center industry. Now, this is not financial advice. This is my personal opinion. I'm still researching this company, so I do reserve the right to change my mind on this stock in the future. If I do change my mind on the stock, find out some other information on the stock as I'm doing my research, I will alert everybody in the VIP group. So if you do want those updates, guys, feel free to check out that first link in the description below. If you did find any value in this video at all, feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. And if you still haven't subscribed, feel free, join the investing family, hit that subscribe button, turn that notification bell on. And with that being said, thank you guys so much for watching. I hope you all have an incredible day, and I'll see you in my next video. Invest safe.